Something extraordinary just happened in the silver market that most people completely missed. While everyone's been watching gold hit new highs, silver quietly crossed a threshold that historically has preceded massive price explosions. And I'm not talking about some arbitrary technical level on a chart. I'm talking about a fundamental shift in market structure that's only happened 3 times in the last 50 years. Each time, silver went on to multiply several times over within 18 months. Let me show you exactly what I'm seeing because the implications are staggering. We're witnessing the convergence of supply constraints, industrial demand acceleration, and institutional positioning that creates what traders call a perfect storm. But here's what makes this moment different from every other silver rally you've seen. The physical market has completely decoupled from the paper market. That sentence might not mean much to you right now, but by the end of this video, you'll understand why it changes everything. Start with what's happening on the ground level. Silver mines aren't producing enough metal to meet current demand. That's not speculation, that's mathematical fact. Global silver production has plateaued while industrial consumption keeps climbing at rates that would have seemed impossible just a few years ago. Solar panels alone are consuming silver at exponential rates. Each panel requires about 20 grams of silver, and the world is installing solar capacity faster than ever before. China's building solar farms the size of small countries. Europe's racing to meet renewable energy targets. Even oil-rich Middle Eastern nations are pivoting to solar infrastructure. But solar is just one piece of a much larger puzzle. Electric vehicles use twice as much silver as traditional cars. Every EV rolling off the production line contains nearly an ounce of silver in its electrical systems, battery management, and charging infrastructure. And we're not talking about a niche market anymore. Major automakers have committed to going fully electric within the next decade. That's millions of vehicles per year, each one demanding silver that the market simply doesn't have in surplus. Then there's 5G infrastructure. The build-out happening right now requires silver in ways previous generations of wireless technology never did. Every cell tower, every base station, every piece of network equipment uses silver because of its unmatched electrical conductivity. Medical applications keep expanding too. Silver's antimicrobial properties make it irreplaceable in healthcare settings, and that demand accelerated dramatically during the pandemic and never came back down. Every smartphone, every computer, every electrical switch in your house contains silver. It's the most conductive metal on Earth, and there's no substitute that works as well at any price point. Now here's where it gets interesting. When industrial users can't get physical silver, they don't just stop production. They pay whatever it takes. We're seeing premiums on physical silver bars and coins that are completely disconnected from the spot price you see quoted on financial websites. That spot price reflects paper contracts traded on the COMEX, but try to actually buy significant quantities of physical silver at that price. You can't. The real price, the price where actual metal changes hands, is running 15 to 20% higher in some markets, and in certain forms like coins and small bars, premiums have spiked even higher. This spread between paper and physical tells you everything about market stress. It's like watching a dam develop cracks. The paper market says silver should be at one price, but the physical market is screaming that there isn't enough metal available at that price. Something has to give. Either the paper price rises to match physical reality, or the paper market breaks entirely. Both scenarios are explosively bullish for anyone holding physical silver. Let's talk about what's happening in the warehouses. COMEX silver inventories have been draining at an accelerating rate. These are the registered stocks, the silver that's actually available for delivery, against futures contracts. Recent data shows these inventories have dropped to levels we haven't seen in years, and the rate of decline is speeding up. Every month, more silver leaves the warehouse than enters. That's not sustainable. Eventually, you run out of silver to deliver, and when that happens, the price has to rise until it destroys enough demand or creates enough new supply to rebalance the market. But here's the problem that nobody in the mainstream financial media wants to talk about. Silver supply doesn't respond quickly to price signals. You can't just flip a switch and produce more silver. Most silver, about 70%, comes as a byproduct of mining other metals like copper, lead, and zinc. Even if silver prices double tomorrow, it takes years to bring new mine capacity online. The lag time between deciding to develop a mine and actually producing silver is measured in years, sometimes a decade. Meanwhile, industrial demand isn't price-sensitive in the short term. Solar panel manufacturers and EV makers can't just stop using silver because the price went up 20%. Their entire production process depends on it. This creates what economists call inelastic supply meeting inelastic demand, and it's a recipe for violent price moves. Small changes in the supply-demand balance create disproportionate price reactions. We saw this play out in palladium when automotive demand collided with supply constraints. Palladium went from under $500 to nearly $3,000 in less than 3 years. Silver has even more extreme supply-demand dynamics right now, with a much larger market that's been suppressed for much longer. Speaking of suppression, let's address the elephant in the room. The silver market has been manipulated for decades through paper contract flooding on the COMEX. This isn't conspiracy theory. Major banks have been fined hundreds of millions of dollars for spoofing and manipulation in precious metals markets. The playbook has been simple. When silver starts rising, dump massive quantities of paper contracts onto the market to create artificial selling pressure. It works because most traders are playing with paper, not physical metal. They see the price dropping and sell, creating a cascade. But that playbook is breaking down right now. The physical market is too tight. When paper prices get pushed down, physical buyers step in and drain inventory. We're watching this happen in real time. Every price dip gets bought aggressively in the physical market, and warehouse stocks keep falling. The manipulators are running out of physical silver to deliver against their paper promises. It's like writing checks your account can't cover. Eventually, someone calls your bluff and demands payment. And here's something fascinating that just came to light. One major bank reportedly holds approximately 196 million ounces of silver in the COMEX system. That's roughly 40% of the entire COMEX silver futures market. Think about that concentration for a moment. One institution controlling nearly half of the paper silver market. What happens when that position needs to be unwound? What happens when industrial users demand physical delivery, and there isn't enough to go around? The price discovery mechanism breaks, and we get a reset to reality. Now let's zoom out and look at the bigger picture, because silver doesn't exist in a vacuum. Central banks around the world are buying gold at record pace. They're diversifying away from dollar reserves, and that trend is accelerating. When central banks buy gold, it validates precious metals as monetary assets. That psychological shift flows into silver. If gold is money, silver is money. Historically, silver has been money for far longer than gold. For thousands of years, silver was the common person's money while gold was for kings and kingdoms. That monetary role never really disappeared. It just got suppressed by the paper currency system. But watch what happens when currency systems come under stress. People remember that silver is real money. They remember that you can't print silver. You can't create it with a computer keystroke, and governments can't devalue it by running deficits. These aren't abstract concepts anymore. People are watching their purchasing power erode in real time, and they're looking for alternatives. Quick aside here, because this is relevant if you're thinking about wealth preservation. If you're sitting on $100,000 or more in retirement accounts, there's a way to get physical precious metals into those accounts without triggering taxes or penalties. I put together a free guide that explains exactly how gold IRAs work, what the rules are, and how to evaluate if it makes sense for your situation. It's in the description below. No pressure, just information if that's relevant to your planning. Back to the market dynamics, because there's another layer most people miss entirely. The silver to gold ratio just hit a level that historically marks major turning points. This ratio measures how many ounces of silver it takes to buy 1 ounce of gold. Right now, that ratio is still elevated compared to historical averages, meaning silver is cheap relative to gold. But here's what's fascinating. Every time this ratio gets stretched to these levels, it snaps back violently. Silver doesn't just catch up to gold, it overshoots dramatically. Look at what happened in the late 70s. Silver went from under $2 to $50 in less than 2 years. The ratio compressed from over 50 to 1 down to 17 to 1. Or look at the move from 2008 to 2011. Silver quadrupled while gold roughly doubled. The ratio compressed from over 80 to 1 down to 30 to 1. These aren't gradual adjustments. They're explosive moves that happen faster than most investors can react to. We're setting up for another one of those moves right now. The ratio is stretched, physical supply is tight, industrial demand is accelerating, and institutional money is starting to pay attention. That last part is crucial. When big money moves into silver, it moves fast and in size. Silver is a relatively small market compared to gold or other commodities. The entire above-ground supply of investment-grade silver is worth maybe $50 billion. That's less than the market cap of many individual tech companies. It doesn't take much institutional buying to move the price dramatically. A few $1 billion flowing into silver can create a price spike that feeds on itself as momentum traders pile in. Here's what that looks like in practice. Imagine a large hedge fund decides to allocate just 1% of their assets to physical silver. They start buying, and the price begins to rise. Other funds see silver outperforming and decide to add exposure. Retail investors notice silver making new highs and start buying coins and bars. Industrial users who were waiting for lower prices panic and start forward buying to lock in supply. Short sellers who bet against silver get squeezed and have to buy to cover their positions. Each wave of buying pushes the price higher, which triggers the next wave. This feedback loop is how silver goes from $25 to $50 in a matter of months. It's not a steady climb. It's a stair-step pattern with explosive moves followed by consolidations. Then another explosive move. The key is recognizing when the setup is in place. And right now, every indicator is flashing green. Supply deficit? Check. Industrial demand growth? Check. Monetary uncertainty? Check. Technical breakout potential? Check. Institutional positioning starting to shift? Check. Retail awareness still low? Check. That last point is important. When your neighbors and coworkers start talking about silver, when mainstream financial media can't stop covering it, when silver becomes a trending topic on social media, that's when you're near a top. We're nowhere close to that yet. Most people still think of silver as some relic from their grandmother's drawer. They have no idea it's a critical industrial metal that's in structural deficit. They don't understand the supply dynamics or the monetary implications. That ignorance creates opportunity for those who do understand. Let's talk about what happened the last time silver had a major move. Silver went from around $17 to nearly $50 in less than a year. That's a nearly 300% gain. But here's what most people forget. Silver didn't just go straight up. It had violent pullbacks along the way. There were moments where it dropped 10 or 15% in a week, shaking out weak hands before continuing higher. Those pullbacks are features, not bugs. They're how markets consolidate gains and set up for the next leg higher. If you understand that pattern, you can position yourself to benefit instead of getting shaken out. The investors who made life-changing money in that move weren't the ones who tried to time every wiggle. They were the ones who understood the fundamental story, accumulated physical metal, and held through the volatility. They knew that short-term price action doesn't matter when you're positioned for a structural shift in supply and demand. Now let's address the skeptics, because there are always skeptics. They'll point to previous false starts, times when silver looked ready to explode but didn't. They'll mention how silver crashed after reaching highs and how it took years to recover. They'll argue that industrial demand can be met with recycling or substitution. Let me address each of these points because they're based on outdated information or misunderstanding of current market structure. First, previous false starts happened when supply was adequate and industrial demand was lower. The market structure was different. We didn't have the same supply deficit, the same industrial consumption growth, or the same monetary instability. Comparing then to now is like comparing a match to a forest fire. The scale is completely different. Second, yes, silver has experienced crashes after explosive moves, but those crashes happened after runs driven largely by investment speculation without the fundamental support we're seeing now. The current setup is different because it's driven by fundamental supply-demand imbalance in the physical market. Industrial users need silver regardless of price. That creates a floor under the market that didn't exist in purely speculative rallies. Third, recycling and substitution sound good in theory, but don't work in practice at current scales. Silver recycling is already happening at maximum economically viable rates. You can't efficiently recycle silver that's been used in tiny quantities spread across millions of products, and substitution isn't realistic for most applications. Engineers have spent decades trying to find alternatives to silver in various applications. If there were good substitutes that worked as well, they'd already be using them. Silver works because of its unique properties, and those properties can't be replicated by cheaper materials. Here's another angle most analysts miss. The geopolitical dimension matters more than most people realize. Silver production is concentrated in a handful of countries. Mexico, Peru, China, and Russia account for the majority of global mine supply. Political instability, resource nationalism, or trade restrictions in any of these countries can disrupt supply chains. We're living in an era of increasing geopolitical tension and deglobalization. Supply chains that seemed stable for decades are being questioned and restructured. What happens if a major silver-producing country decides to restrict exports to secure domestic supply for their own industrial needs? What happens if trade wars escalate and tariffs disrupt the flow of silver between countries? What happens if mining operations face new environmental regulations that limit production? Any of these scenarios would tighten an already tight market and send prices soaring. The fragility of global supply chains is a hidden risk that's not priced into current silver valuations. Now let's connect this to what's happening in the broader economy. We're in an environment of persistent inflation, massive government debt, and central banks trapped between fighting inflation and supporting economic growth. Every major economy is running deficits that would have been unthinkable a generation ago. The solution is always the same: print more money. That devalues currency and makes hard assets more valuable in nominal terms. Silver benefits from this dynamic in multiple ways. As an industrial metal, it benefits from economic activity and infrastructure spending. As a monetary metal, it benefits from currency debasement and inflation hedging demand. As a small market, it benefits from even modest allocation shifts by large investors. This triple support creates a powerful tailwind that's just starting to build. Think about what's happened to asset prices over the last few years. Real estate, stocks, art, collectibles, even cryptocurrencies have all seen massive appreciation. That's not because these assets suddenly became more productive or valuable. It's because the currency they're priced in has been devalued through money printing. Silver has lagged this broader asset inflation, which means it has serious catching up to do. When it catches up, it won't do so gradually. It'll do so explosively, because that's how silver moves. Here's a thought experiment. If you could go back in time and buy silver at $17 knowing it would hit $50 within a year, would you? Of course you would. Now ask yourself, what if we're at a similar inflection point right now? What if the current price represents the same kind of opportunity? You can't know for certain, but you can evaluate the setup and make a probabilistic judgment. The setup today looks remarkably similar to previous major moves, with even stronger fundamental support. The risk-reward is asymmetric. If silver goes nowhere, you own a tangible asset that holds value and has industrial utility. If silver does what it's done in previous supply-constrained environments, you could see multiples of your initial investment. That's the kind of asymmetric bet that sophisticated investors look for. Limited downside, substantial upside, backed by fundamental supply-demand dynamics rather than speculation or hope. Let me paint a picture of what the next 12 to 18 months could look like. Silver breaks through resistance levels that have capped it for years. That breakout attracts momentum traders and technical analysts who pile in. The price surge creates headlines, which brings in retail investors who don't want to miss out. Industrial users panic about supply and start hoarding, which tightens the physical market further. Short sellers get squeezed and have to cover, adding fuel to the rally. Institutional investors who've been watching from the sidelines decide they need exposure and start accumulating. Each of these groups reinforces the others, creating a self-fulfilling prophecy. The price rise validates the bullish thesis, which brings in more buyers, which pushes the price higher. This is how silver goes from $25 to $40 to $60 in a compressed time frame. It's not a smooth ride. There will be pullbacks and consolidations, but the overall trajectory is up, driven by fundamentals that can't be wished away. Now, I want to be crystal clear about something. I'm not telling you silver is guaranteed to go up, or that you should bet your life savings on it, or that there's no risk. Every investment has risk. Markets can stay irrational longer than you can stay solvent. Unexpected events can derail even the best thesis. What I am telling you is that the setup is extraordinary, the fundamentals are compelling, and the risk-reward is favorable for those who understand what they're looking at. The critical turning point isn't some arbitrary price level. It's the moment when the physical market's reality overwhelms the paper market's fiction. It's when industrial users realize they can't get the silver they need at current prices. It's when investors understand that silver is both a monetary hedge and an industrial necessity. It's when the supply deficit becomes impossible to ignore. We're at that moment right now. Consider what's happening with central bank behavior. Global central bank gold reserves exceed 36,000 tons, while official silver reserves are almost zero. Central banks aren't buying silver, which means there's no institutional support propping up the price like there is with gold. Without central bank buying, silver's price is purely a function of industrial demand and investment demand. When the paper system begins to malfunction, when the disconnect between paper contracts and physical availability becomes too extreme, There's no central bank backstop to smooth things over. The price adjustment will be swift and severe. History doesn't repeat, but it rhymes. Every major silver move has been preceded by similar conditions: supply constraints, industrial demand growth, monetary uncertainty, and a market that's been suppressed below its fundamental value. We have all of those conditions today, arguably more extreme than previous cycles. The question isn't whether silver will move, it's whether you'll be positioned when it does. The investors who make generational wealth aren't the ones who chase performance after it's obvious to everyone. They're the ones who recognize inflection points before the crowd, who understand fundamental value, and who have the conviction to act when the setup is right. This is one of those moments. The critical turning point isn't coming, it's here. The market structure is breaking, the fundamentals are screaming, and the opportunity is staring you in the face. What you do with that information is up to you. You can wait for more confirmation, more proof, more certainty. But by the time everyone agrees that silver is going higher, the easy money will already be made. The best opportunities always look uncertain at the beginning. That's what creates the opportunity. If it were obvious, the price would already reflect it. The fact that most people are still skeptical, still waiting, still unconvinced, that's actually bullish. It means the move hasn't happened yet. Think about the people who bought gold when it was $300 an ounce. Everyone thought they were crazy. Gold had been in a bear market for 20 years. The conventional wisdom was that precious metals were dead money. But those contrarian investors understood something the crowd didn't. They saw the monetary system's structural problems. They recognized that paper currency debasement was inevitable. They positioned themselves before it was obvious, and they made fortunes when gold went from 300 to 1900. Silver is setting up for a similar move, but with even more explosive potential because of the industrial demand component. Gold is primarily a monetary metal. Silver is both monetary and industrial. That dual demand creates a tighter market with less elasticity. When silver moves, it moves harder and faster than gold. The historical record proves this. In percentage terms, silver outperforms gold in bull markets and underperforms in bear markets. It's a leveraged play on precious metals with the added support of industrial consumption that can't be turned off. So here we are. Silver at a critical turning point, with supply deficits, industrial demand acceleration, monetary instability, and a market structure that's ready to break. The setup is extraordinary. The fundamentals are compelling. The opportunity is real. This is it. The moment when everything aligns, when the stars line up, when the market is offering you a chance that doesn't come along often. The paper market can only suppress physical reality for so long. Eventually, the laws of supply and demand reassert themselves. Eventually, the price has to rise to clear the market. Eventually, the disconnect between paper promises and physical availability becomes too extreme to maintain. We're approaching that breaking point right now. The cracks are showing. The inventory is draining. The premiums are widening. The industrial users are getting nervous. The smart money is positioning. What you do next will determine whether you look back on this moment with satisfaction or regret. The choice is yours. The information is in front of you. The opportunity is available. The critical turning point is here. This is it.